Okay, it's time for chapter 16. For this chapter, we are going to be looking at the statement of cash flows. We were introduced to this way back in Accounting 1, actually in chapter 1, but we really didn't look at it in detail. We looked at what it was, but not how to prepare it. So in this chapter, we're going to look at how to prepare it. There are some slides that I recommend saving, jotting down in your notes, or taking a picture of because they're going to help you as you go through the chapter. All right, so let's look at our first objective, and this is where we're looking at the differences between operating, investing, and financing activities. And we're also going to learn what a non-cash investing and financing activities are going to be. So before we get too far into that, let's talk about why do we do the statement of cash flows? Well, the gist of it is that it is showing you the inflows, the cash receipts, and the cash payments or outflows during a period. Our cash flows are going to be separated into those three different categories: operating, investing, and financing. The details that we're looking for the sources and uses of cash is what makes this statement useful to our accounting users. So we think about what is useful information. Well, we want to be able to answer the kind of questions that tell us what explains the change in our cash balance, because that's what we're looking at. When we look at a statement of cash flows, it is summarizing the amount of cash and cash equivalents entering and leaving a company. This statement is going to show us how well a company manages the cash position that they have, and that tells us basically how well the company is generating cash to pay its debt obligations or to fund its operating expenses. The cash flow is kind of a complement to the balance sheet and the income statement, and it is a mandatory part of a company's financial reports. It's been mandatory since 1987. So we're going to look at how it's structured and how we can use it when we're analyzing a company. So first, again, we see, that there are three different sections, and we want to know, where does the company spend the cash? How do they receive their cash? Why is income different than cash flow? And they are different, so we're going to look at some of those. And then hopefully by looking at those, we're going to get some key insight into the statement of cash flows. So let's look at our next part. So we look at the importance of cash flows. So this is going to tell us, it's going to help our users decide a lot of information. So it's going to help them decide whether a company has enough cash to pay its debts as they mature. It helps evaluate the ability to pursue opportunities. It's going to allow managers to use that cash flow information to plan their day-to-day operations, and it's going to help the managers to make those long-term investment decisions. When we look at the measurement of cash flows, so cash flows include both the cash and cash equivalents. So the statement of cash flows explains the difference between the beginning and the ending balances of cash and cash equivalents. We continue to use the phrases cash flows and the statement of cash flows, but remember that both phrases refer to cash and cash equivalents. A cash equivalent has to satisfy two core criteria. The first is it has to be readily convertible to a known amount of cash, and it has to be close to its maturity date so that the market value is not affected by interest rate changes. So those are things that we have to look at first. All right, so we're going to have three different areas in the statement of cash flows, three different sections. So when we look at those, it's not going to report transactions between cash and cash equivalents like if we paid cash to purchase cash equivalents. We're going to see the overall changes in those two accounts, or in that account in those areas. So all other cash receipts and cash payments are going to be classified and reported on the statement in one of three categories: operating, investing, or financing activities. When we look at individual cash receipts and payments for each of the three categories, we're going to be labeling them, identifying what the originating transaction or event was. So if we have a net cash inflow or a source, and that occurs when the receipt of a category exceeds the payments. If we have a net cash outflow or use of cash, that occurs when the payments exceed the receipts. So we'll look at all three of the sections. So let's start with operating activities. Well, what is operating activities? Those are things that are going to be accounts that are going to affect our net income. So examples are going to be the production and the purchase of inventory, the sale of goods and services to customers, and the expenditures to operate the business. Not all of these items in income, such as unusual gains and losses, are operating activities. So we see some of that and we'll talk about them more in detail. So this slide has more of the common cash inflows and outflows from operating activities. When we think about these, operating activities is going to include any source or use of cash from business activities. So it's going to reflect how much cash is generated from a company's product or service. Some of the things, again, here in this slide, it shows you some examples. So we're looking at receipts from sales of goods or services, interest payments, income tax payments, payments made to suppliers of goods or services used in production, salary and wage payments to employees, rent payments, and the other operating expenses. We're going to be looking at the indirect method. So when we talk about different methods, you will see the direct method mentioned in your book. But when we look at all of our ways that we are preparing, it is all going to be under the indirect method. So when we prepare a cash flow statement under the indirect method, depreciation, amortization, deferred tax, gains and losses with non-current assets, and dividends or revenue received are also going to be included. But we're not going to include the purchase of or sale of long-term assets in our operating activities. All right, so let's look at our next section, investing activities. So investing activities are going to include the things that come from the purchase and sale of long-term assets. So they include the purchase and sale of short-term investments in other entities and lending and collecting money for notes receivable. This slide lists the other examples of cash flows from investing activities. We see that cash from collecting the principal on notes is an investing activity. However, collecting interest on notes is an operating activity. So we're going to see the principal is an investing activity. The interest is an operating activity. So if a note results from sales to customers, it is an operating activity. Let's look at the financing activities. All right, these are going to be the long-term liabilities and equity. So the things that affect long-term liabilities and equity. Examples are going to be obtaining cash from issuing debt and repaying debt, and receiving cash from or distributing cash to owners. We're going to be looking at borrowing and repaying principal on both short and long-term debt, and they are going to be considered financing activities. Remember, payments of interest are considered operating activities, so we won't include them in this section. When we're looking at financing activities, it's going to include, again, the sources of cash from investors or banks, as well as the uses of cash paid to shareholders. So we might see payments of dividends, payments for stock repurchases or treasury stock, and then we might see the repayment of debt principal or loans also in this category. All right, so as we can see here, there is a link between the statement of cash flows and the balance sheet. And we're going to have a couple of slides also that are going to help us with some of our calculations later on. So when we look at the operating, investing, and financing sections really closely, we see that they are linked to different parts of the balance sheet. Our operating activities are affected by changes in current assets and current liabilities, and therefore the income statement. Investing activities are affected by changes in long-term assets, and our financing activities are affected by changes in long-term liabilities and equity. There's an exhibit 16-4, which is this, in your book that you can refer back to as you need to. When we think about some of the exceptions to the links, we have current assets that are unrelated to operations. So things such as short-term notes receivable from non-customers and from investment securities. So those are going to be investing activities. And then we have current liabilities that are unrelated to operations, like a short-term notes payable and a dividend payable, and those are financing activities. The other thing we have to look at are non-cash investing and financing. So some of the investing and financing things that we see on the cash flows. So we have one example would be the purchase of long-term assets, but instead of using cash, We buy that long-term asset, such as equipment, by issuing a long-term note or even a bond payable or some kind of a loan. So this transaction is going to involve both investing and financing, but it does not impact the current period cash. So those transactions are reported at the bottom of the statement of cash flows or sometimes in a note to the financial statement because of their importance. And also remember, we have to remember the full disclosure principle that says we have to disclose it if it would affect someone's decision. So this slide has a couple of other transactions that are commonly disclosed as non-cash investing and financing activities. All right, so now that we've learned what a statement of cash flows is, let's now look at how we prepare one. So again, we are using something called the indirect method. And again, we're on the formatting for the statement of cash flows. We're going to see operating activities listed first, investing activities, and then financing. We're going to see our net change in cash, whether it's an increase or a decrease. And then we're also going to see what the balance was in the prior period. And that net increase should be the difference between what it was in the prior period and what it is in the current period. All right, so we are going to be looking at a few different steps to do the statement of cash flows. First, we're going to compute the net increase or decrease in cash. We want to know, what did cash change from one period to the other? Then we're going to be looking at the net cash from, which is a positive amount, or used by, a negative amount, by operating activities. Do the same thing for investing and then financing. Then we're going to compute the net cash flow from all sources and prove it or check it by adding it to the beginning cash balance and getting the ending cash balance, and they should tie together. All right, so again, we're going to be analyzing the cash account. So computing the net increases or decreases is simple, but we have to make sure that we do it correctly. So it's going to equal the current period's cash balance minus the prior period's cash balance. This is the bottom line figure for the statement of cash flows, and it's our way that we check to see what happened and if it balances at the bottom. So a company's cash receipts and cash payments are recorded in the cash account. The cash account is one place to look for information about cash flows, whether it's going to be the operating, investing, or financing activities. So as an example, look at the cash T account here for Genesis. And it shows that the cash account increased $5,000 from $12,000 at the beginning, December 31st, 2020, to $17,000 at the end, December 31st, 2021. And then we have the individual cash transactions that are summarized in the cash account according to the major types of cash receipts and cash payments. So, for example, only the total of cash receipts from all customers is listed. The individual cash transactions that make up those totals can be thousands depending on how large your company is. So accounting software is able to provide those summary amounts for you. And that's going to help us as we go through to analyze it. So again, our statement of cash flows is going to summarize and classify the transactions and explain how we went from $12,000 to $17,000 or had an increase of $5,000. We're going to be preparing a statement of cash flows, and that's going to require determining whether an individual cash outflow or inflow is falling under the operating, investing, or financing section, and then listing each of those activities. We're also going to be analyzing those non-cash accounts. Remember, we had to look at what happened that was in non-cash. And remember, all cash transactions eventually affect non-cash balance sheet accounts. So we can determine inflows and outflows by analyzing those changes in non-cash balance sheet accounts. So we want to take those out. So this slide kind of uses the accounting equation to show the relation between the cash account and the non-cash balance sheet accounts. All right, in our next video, we will continue and look into the actual preparation of the cash flow statement.